Have you ever looked at a company and just felt like you were getting two completely different stories at the exact same time? Well, that's what we're going to try and unravel today with Manis Infraconstruction, or MICL. See, on one hand, their financial reports look incredibly solid, but on the other hand, some analysis are screaming that its stock price is way too high. So let's dive into this valuation puzzle.
First, let's look at the case for strength. The company is, and this is a big deal, a net debt-free company. You know, in the world of construction and real estate, borrowing is the name of the game. So for a company to not have net debt, that's a massive green flag. It signals real financial health and stability.
But then you see a number like this. One super detailed analysis, which we're going to get into, calculates that MICL stock is overvalued by a staggering 211.5%. So you have to ask, how can a company that's fundamentally debt-free be seen as so wildly overpriced?
And that, right there, is our central question. Are we looking at a rock-solid company that the market is just, not getting right? Or is this a dangerously overvalued stock that's kind of disconnected from its true worth? Let's break down the evidence and see if we can solve this thing.
This really is a tale of two completely different valuations. We're going to look at the evidence for each side of the story, and we'll start with the company's strong foundation.
All right, part one, the case for MICL's solid financial foundations. Here, we're really looking at what the company actually owns versus what it owes.
And right away, the evidence is pretty compelling. According to one analysis, MICL has a perfect financial health score, a 6 out of 6. I mean, that's a top-tier rating. It suggests a really low risk of any kind of financial trouble based on its balance sheet and its debt levels.
Now check out this table. This shows the company's net worth. That's basically its assets minus its liabilities. Just look at that clear upward trend. Its core value is growing steadily, and it's projected to get close to 2,000 crore rupees. This is not a company that's shrinking. Its fundamental financial base is definitely expanding.
This slide really drives home what some are calling a fortress balance sheet. They're net debt-free, with a tiny gross debt of just 36 crore rupees. And crucially, they have high liquidity, holding somewhere between 491 and 570 crore rupees in cash. All this results in a debt-to-equity ratio under 2%. That is an incredibly low number and signals very minimal financial risk.
So the books look great, right? But what do investors think it's worth right now? Let's move on to part two and see how the public stock market is actually pricing this company.
Okay, one of the most common ways to look at this is the price-to-earnings ratio, or PE. It pretty much tells you how much investors will pay for every single rupee of profit. MICL's PE is 23.7. Now, is that high? Well, if you compare it to the average of the entire Indian market, which is almost 28, it's actually lower. This suggests that, at least on this key metric, the stock isn't being priced at some kind of crazy premium. And other metrics, they kind of give us a similar picture. Its price-to-sales and price-to-book ratios are 6.5 and 3.5. These are just different ways investors measure a company's price against its sales and its net asset value. And while they aren't super low, these numbers don't immediately scream extreme overvaluation either.
But here's another twist in the story. Despite its strong internal finances and its reasonable valuation multiples, the stock has actually underperformed recently, both against the Indian construction industry and the broader Indian market. So this tells us the market might be a little cautious, a bit hesitant about the company's immediate future, which just adds another layer to our puzzle.
Okay, let's get to the most dramatic piece of this whole puzzle. We've looked at the company's assets, we've looked at the market's current price. Now, for part three, we're going to examine a valuation based not on today's assets, but on future potential. This is the intrinsic value question.
So before we see the big number, let's quickly define what we're even talking about. Intrinsic value isn't about the stock price today. No, it's an estimate of a company's true worth, based on all the cash it's expected to generate way out into the future. And the most common way to calculate this is something called a discounted cash flow, or DCF model.
And here it is, the bombshell. According to this model, while the stock trades around 153 rupees, its true intrinsic value is estimated to be only 49 rupees per share. That is where that massive 211.5% overvaluation figure comes from. It's a direct challenge to the market's current price.
And just to make things even more interesting, you have to remember that valuation is not an exact science. On the very same platform that gave us that intrinsic value calculation, a different metric they call community fair value suggests the stock is actually 13% undervalued. This just goes to show you that different models and different assumptions can lead to wildly different results.
So we've got a fortress balance sheet, a reasonable market price, and a shocking intrinsic value estimate. How do we solve this thing? It's time to connect the dots.
Here's how we solve the puzzle. There isn't one single right answer because there are 3 different lenses to value a company. The asset-based approach asks, what does it own? That's where we saw the strong net worth and low debt. Then there's the market approach. It asks, what do investors think it's worth today? And that's our PE ratios. And finally, the income approach asks, what will it earn in the future? That's the intrinsic value and the DCF model. So here's why the numbers disagree. From an asset perspective, this company is strong and valuable. That balance sheet is solid. From a market perspective, well, investors are being a little cautious, the ratios are reasonable, but performance has lagged. But from a future income perspective, that DCF model is basically screaming that the company's future cash flows don't support the current high stock price. Each lens is telling a different part of the story.
And that brings us to the big question, right? Which of these stories should an investor or even just an observer pay the most attention to? The solid present or the uncertain future?
What this entire puzzle really reveals is that classic age-old conflict in investing, value versus growth. You see, value investors focus on the strong assets and reasonable price today, that fortress balance sheet. But growth investors, they're betting on future earnings, and that high stock price suggests they expect huge growth, even if some models disagree. And MICL is sitting right at the intersection of these 2 philosophies.
And that leaves us with this final, really thought-provoking question. Is Mann Infra Construction a fundamentally safe company that just happens to be trading at a risky price? The answer, it seems, depends entirely on which valuation lens you choose to look through. And that perfectly captures the challenge and maybe even the fun of trying to figure out what a company is truly worth.